This video is for educational and informational purposes only and should not be considered financial advice. Any analysis of Eli Lilly is based on publicly available information and my own assumptions. This is part 2 of a 3-part value investing analysis of Eli Lilly. In this part, we'll take a closer look at Eli Lilly's financial strength and the overall quality of the business by analyzing key financial ratios. Moving on to return on equity. To calculate return on equity, you take net income divided by average shareholders' equity. Average shareholders' equity is equity from 2024 plus equity from 2025 divided by 2. Eli Lilly's return on equity is exceptionally high across the last 5 years, consistently ranging from roughly 50% to well above 100%. At first glance, that looks extraordinary, but it's important to understand what's driving it. This is not primarily the result of a growing equity base. Instead, return on equity is elevated because Eli Lilly operates a capital-light, R&D-driven business model and has returned large amounts of capital to shareholders through buybacks and dividends. As a result, return on equity here is best viewed as a confirmation of strong earnings power, not as a standalone measure of value creation. The real story still sits in operating margins, cash flow generation, and return on invested capital. Next, let's look at return on invested capital. For pharmaceutical companies like Eli Lilly, return on invested capital is more informative than return on equity because it measures true capital efficiency across the entire business, not just returns on a shrinking equity base driven by buybacks. While return on equity calculates how much profit a company generates relative to shareholders' equity, return on invested capital calculates how much operating profit the company generates relative to all the capital invested in the business, both debt and equity. Here is the formula for calculating return on invested capital. We take net operating profit after tax, or NOPAT, and divide it by average invested capital. To calculate net operating profit after tax, we take operating income multiplied by 1 minus the tax rate. Operating income for 2025 was $29 billion and $696 million, while the effective tax rate was 19.8%. You can find the effective tax rate in Eli Lilly's 2025 annual report. This gives us a net operating profit after tax of $23 billion and $816 million. To calculate invested capital, we take equity plus interest-bearing debt minus cash and cash equivalents. We calculate this for both 2024 and 2025 in order to determine average invested capital. After finding average invested capital, we can calculate return on invested capital for 2025. That gives us a return on invested capital of around 44%. This is a simple way of calculating return on invested capital. If you go to simfin.com, they have calculated historical return on invested capital for us. While I calculated return on invested capital for 2025 at 44%, Simfin calculates it at 33%. Different sites use slightly different methodologies when calculating return on invested capital. The important thing is not the exact method, but that you remain consistent in the method you use. So for consistency, we will use Simfin's data. We can see that return on invested capital has historically ranged between 21 and 33%. Over 10% indicates a solid business, over 20% suggests a high-quality business, while over 25% is exceptional. In strong periods, large-cap pharma companies typically generate return on invested capital between 15 and 25%. 25 to 30% is considered top tier. Above 30% is rare and signals strong pricing power and a durable moat. A return on invested capital consistently above 20% and recently above 30% places Eli Lilly in the top tier of global pharma. This level of capital efficiency suggests a strong moat, pricing power, and disciplined capital allocation. Another important metric is debt to equity. Looking at the balance sheet, Sigyn Alpha has calculated total debt for us. For 2025, total debt was $43 billion and $865 million, while total equity was 26 billion and 535 million. That gives us a debt to equity ratio of 1.7. This means that for every $1 of equity in the company, Eli Lilly has $1.7 of debt. For pharmaceutical companies, a ratio between 0.5 and 1 is typically considered normal. So 1.7 is clearly above that range. And we can see that over the last couple of years, Eli Lilly's debt to equity has been between 1.5 and 2.5. Eli Lilly's debt to equity ratio is clearly above what we normally see in pharmaceutical companies. However, this must be interpreted in context. The company generates enormous operating cash flow, and much of the increase in leverage is linked to aggressive capacity expansion and capital allocation decisions, not financial distress. It is also important to understand that the debt to equity ratio can worsen mechanically when equity declines. Share buybacks reduce the equity base, which automatically pushes the ratio higher, even if total debt does not increase proportionally. Importantly, the ratio has already declined in 2025, suggesting the balance sheet is stabilizing rather than deteriorating. And more importantly, leverage only becomes a problem if the company earns less on its invested capital than it pays in borrowing costs. Lilly's recent return on invested capital has been in the mid-20% range, while its effective interest rate on debt is only a fraction of that. When return on invested capital significantly exceeds the cost of debt, leverage is not destructive, it is value creating. So while the ratio looks elevated on the surface, it does not currently signal balance sheet risk, but it is something I will continue to monitor. Continuing looking at Eli Lilly's debt level, we'll turn to the current ratio. The current ratio measures a company's short-term liquidity, in other words, its ability to cover short-term liabilities with short-term assets. Over the past 5 years, Lilly's current ratio has ranged from 0.9 to 1.9. In 2023, the ratio dipped to 0.9, meaning current liabilities slightly exceeded current assets. However, the ratio rebounded to 1.2 in 2024 and further to 1.6 in 2025. This rebound suggests that the 2023 dip was temporary rather than structural. For a large, cash-generative pharmaceutical company like Lilly, a current ratio between roughly 1 and 2 is generally considered healthy. A great business is not always a great investment. In part 3, we will value Eli Lilly using the PE ratio, price-to-book ratio, and a discounted cash flow model to estimate its intrinsic value and determine whether the stock is attractively priced.